Live here.
Is just leave it at the door. I'm in a webinar.
Okay, thank you everyone. We are live, and of course, right as we go live, Amazon decides to deliver my stuff, and my kids come screaming at me. So I apologize for that. I am joined today by some amazing guest speakers. I'm going to introduce them by their first name, Eric and Leo, because my French accent is terrible, and I did not want to butcher either of their last names. But we're excited to have them here today, and we're excited to share with you our session today, which is on financial intelligence and the future of corporate investments, which I know many of you as customers of CPA4IT are very interested in. And we've had lots of questions to try and get into the weeds and the details of how the program works. And I'm excited to have these guests with us today to share with you how that does work. So for those of you who are not familiar with myself, my name is Andrew Wall. I'm the managing partner here at CPA4IT. And our mission at CPA4IT is to help you organize your finances, create wealth, and transform wealth into a legacy. And we have partnered with IT360 and the NEURONE platform to help our clients grow their financial net worth, because we know financial planning is such an important part of growing your net worth. And we're excited to have with us today Leo from the IT360 team, who's going to tell you a little bit more about the NEURONE platform and how that works, and give you some more insights into how you can organize your finances, create wealth, and transform wealth into a legacy. So Leo, thank you for joining us. And please let us know if you do have any questions in the audience, share them with us. Leo, Eric, and I are here to answer your questions and to help you as best as we can. So Leo, thank you for joining us today. How are you doing?
Yeah, thanks for having me, Andrew. I'm doing very well. It's always a pleasure. Yeah.
Oh, and I thought I was sharing my screen, but apparently I wasn't. And now at the time I need to stop sharing so that you can share. That one delivery really messed up.
Yeah, exactly. It played in your head. It played with your head.
I literally shut my doors, and I can now hear my dog scratching at my door. It's the joys of live sessions.
Let's go, Leo.
All right, perfect. But thank you, Andrew. Thanks for setting this up. I'm happy I'm able to join. I think today's conversation should be pretty insightful. Hopefully eye-opening as well. I think the title. Actually, I'm going to share my screen. I won't do the same mistake, Andrew. Sorry about that. So we'll pull it up on the screen here for you guys. There we go. Just a second. Yeah. So the title for today is the future of corporate investments. Okay. Don't know why my screen sharing. Okay, there we go. Can we get a thumbs up?
Not yet for me.
Not yet.
All good? All right, perfect.
No,
not yet.
No.
Not yet?
No.
No.
It might be the same thing I had. There's a second pop-up screen that comes up.
Okay, sorry about that, guys.
No problem.
We'll start over. Okay, I wasn't sharing my screen, I think. So there we go. Share.
There we go. Now I can see something.
I think it's coming. Yeah.
All right, yes. There we go.
Yes.
Okay.
Good job, Leo.
We should have practiced more, guys, but it's okay. It's okay. All right. So the future of corporate investments. Let the NEURONE team build your strategy. So we're really going to talk about corporate investment. We're going to do that through the lens of NEURONE financial intelligence today. For the past, 20 plus years, our team has developed a pretty unique approach when it comes to corporate investing. And we've developed innovative tools, tools that now help us build plans, build strategies for hundreds of IT consultants pretty much all across Canada now. So it's something that we're pretty proud of, and it's something that we'll be discussing today. So I guess quickly just about myself. So I've been working with business owners, with IT consultants since 2021. So pretty much in the midst of the pandemic. Since then, I've mostly specialized in what we call the executive pension plan. We'll be talking about the EPP later on, but most of my time is spent within the NEURONE team. Among other things, okay, so licensed financial planner. I'm from Quebec, and also a board member of the ARSF, which is a nonprofit within the financial services industry. What we'll be talking about for the next maybe 30 minutes or so, we'll start obviously by addressing the context, right, and the common misconceptions, what we call broken paradigms. So we'll talk about that from obviously a financial planning point of view. We'll then define NEURONE. Okay, so what is NEURONE? You've heard about it. You've seen it maybe online, on LinkedIn, or wherever you may have seen the name. So we're going to look at what is NEURONE, how do we operate, okay, and how we ultimately add value. We'll be talking about the corporate investment policy as well, right, which is basically our global investment philosophy that we use for the business owners and the IT consultants that we work with. And then we'll obviously end things off by talking about the NEURONE Tool, which for us is a true game changer in terms of corporate wealth management. It's a unique tool that ultimately provides a roadmap, okay, a very precise roadmap to follow in order to leave more money in your pockets and in the hands of your loved ones. All right, so that's what we'll be covering today. Starting with the environment, you know, from having worked with many business owners over the past couple of years, obviously for us, we realize that your priority as a business owner is the business, okay? And for consultants, it's the same thing. Your priority is your practice, making sure you're making a good job, finding your next contract, right? So that's your reality, that's your main focus. For us, our priority is wealth management, okay? And making sure that we're always staying on top of things in a context that changes and a context that evolves. And when we look at the corporate landscape, okay, and the different rules, the different laws that business owners, that IT consultants are now subject to, we realize that the environment that we're in today is far more complex than it was 10 years ago. Okay, so it requires a change. It really requires a different approach. And I put a couple examples on the screen for you guys of some of these changes that we've seen. One of them happened in 2018, where business owners now, such as incorporated IT consultants, right, people who earn too much investment income in their corporation could potentially lose the small business deduction limit. Okay, so small business deduction limit between, $500,000 limit between the lower and the higher corporate tax rate. So when our passive income, right, income from it could be a GIC, it could be a rental property, it could be dividends, okay, interest income. When that income exceeds a certain amount, okay, which is $50,000 in a corporation, we gradually lose our small business deduction limit. So once we get to $150,000, we don't have any small business deduction left, which leads to more corporate tax. Okay, I'm from Quebec. A lot of our clients are from Quebec. They can potentially have to pay $71,000 in additional corporate tax every year if they're not properly managing their passive income. So that's one example. We could also talk about the tax on split income and how those rules have changed over the past 10 years. Previously, it was very easy to do income splitting with family members using dividends. Now family members have to have an actual involvement in a corporation to allow that efficient income splitting. And then finally, another thing we like to bring to light is the investment taxation issues. So the taxation issues that occur when they're earned in a corporation. So when we invest in a corporation, which most of you probably are doing right now, right? We look to draw out, and so we invest and we look to draw out that income personally. We must pay corporate and personal tax, right? And on certain types of investment income, when we combine those two levels of taxation, we realize that we find ourselves paying a lot more tax than we think. Okay, and I put a couple examples of certain types of income that can be earned in a corporation, and we see, for example, for a foreign dividend, right, how that tax rate can reach upwards of 67%. So we think we're making $3 on our investments, but in reality, we're making $1. Okay, this is what we call toxic investments. It's something that's changed over the past couple of years. It's something that is not being talked of enough. We focus a lot on, you know, having the highest returns and having the lower fees, right? But for us, the true wealth killer, as I say, is often found in the tax impact of our investment. So basically, here what's important to understand is that the context that we are in is evolving. So our tax planning opportunities and the strategies that we use, they must evolve as well.
Yeah, and I think that that's such an important part that you guys focus in on, that I think a lot of people really don't realize. You know, we did a session a few weeks ago about the difference between RSPs, TFSAs, RESPs, and all the different investment platforms. And I know it can be confusing to people. And I mentioned in the session that, you know, there's good uses of different vehicles for different types of investment. And people don't realize that those toxic investments, if you wanted to hold them for whatever reason, if you hold them in an RSP, you know, it's a lot better than holding them inside of your corporation. And that's why it's so important to work with a financial planner like you guys, who really truly understand the tax implications of where it makes sense to hold certain investments, right? Because if you have someone who really wants to have, you know, a stock, you know, a European stock that's paying dividends for whatever rationale in their head that they want to hold that, there are ways to hold that without having the tax impact being as negative as it would be if you just held it inside your corporation. And people really don't realize that there are differences between the different types of investment vehicles. And we love investing in the corp because you're investing with, you know, money that's been taxed at the corporate tax rate, which here in Ontario is only 12.2 on that first 500,000. But if you don't understand, you know, tax on passive income, if you don't understand tax on split income, if you don't understand these toxic tax rates, that you can end up doing yourself a tremendous disservice. And I think that's one of the big reasons we choose to partner with IT360 and your team, is because you guys do understand not only the investment side, but the tax implications of the investments. And the way that we can work together on these strategies and these plans ensures that our clients have a better opportunity to organize their finances, create wealth, and transform that wealth into a legacy.
Definitely.
So I just want to reiterate that point to those people on the call today of how critical that is and how much knowledge and expertise the IT360 team have on these aspects.
Yeah. Yeah. 100%. And I think that the parallel is perfect, right, for what we're going to talk about next, because what you're explaining, Andrew, is making sure we have the right vehicle for the right investment, but we also need to have the right investment for the right investor. Okay.
Yes.
And for us, this is really what we come to realize. I put Eric's book on the screen, right? The Wealth Algorithm for IT Consultant. In the book, Eric talks about broken paradigms. Okay. And I can't quote Eric. I don't have the book nearby, but basically, broken paradigm is standard advice, standard ways of thinking that we commonly see in the finance industry. But a lot of the time, this common advice, it's going to work. It's going to work for 90% of people. But this common advice, it doesn't always work when we apply it to an incorporated IT consultant. So that's why we need the right vehicle for the right investment, but also the right investment for the right investor, right? So we need to rethink this approach. NEURONE obviously is something that's one of our key values. I put a few examples of the broken paradigms that we find in Eric's book. The first one being a really good one, right? Fixed income to mitigate market risk. We hear that all the time. If you want to diversify, just invest in bonds, GICs. They're not as risky, okay? Right? We just saw how interest income in a corporation can be taxed upwards to 60%. Okay, so obviously there has to be a better way to mitigate risk, especially if you're an incorporated IT consultant. Okay, so basically the message here, above taking into account the context, right? The situation as an IT consultant requires us to adapt, use those tax planning strategies that are efficient, and also use tools, right, that will create that lasting wealth. And that's exactly the goal that NEURONE hopes to achieve, right? So the key question, what is NEURONE? NEURONE Financial Intelligence, to me, right, my definition of NEURONE is a combination of expertise and innovation. Okay, so yes, there's NEURONE, the name, but behind NEURONE, there's obviously a team of specialists when it comes to wealth management for IT consultants and business owners. And in the NEURONE team, which I get to be a part of, this team works with industry-leading optimization tools. Okay, so tools that are capable of integrating different financial strategies that will be properly adapted for you, someone who has that corporation. So sure, our approach can be somewhat sophisticated, but it's simple for you to follow and it's simple for you to understand. And that for us is really what's the most important thing. Okay. So through our approach, obviously we're going to talk about tax optimization. So how we can minimize tax. That's going to be a common theme. We look to find efficient ways to manage risks as a practicing IT consultant. So protecting yourself, your corporation, your family. We assist in punctual decisions as well, right? So someone could come to us and say, hey, you know what? Next year I need $30,000. I have this boat that's online on Marketplace that I want to buy. Where do I take this $30,000? Should I increase my salary? Should I draw out a dividend? I could do a shareholder loan. Maybe I could take that money from my TFSA. So the NEURONE team and the NEURONE tool will help us answer those questions. And we do so by doing different profitability analysis, right? So we do in-depth analysis to back up the recommendations that we provide. So really the way to summarize it is when you think of NEURONE, think of a team of specialists in the corporate wealth management field that work with very advanced tools that helps us answer those complicated questions in a way that you will understand and be able to see the added value for yourself.
And Leo, one thing that you can discuss is that the tool didn't really exist on the marketplace, you know, like, I mean, yes, you have a team, a full team, but the tool was designed by the lab because nothing really was up to par to help business owners in their decision making along the way. So can you just talk a little bit about this, you know, for the people?
Yep, I will. Actually, I think I have 2 or 3 slides later on in the presentation to answer that exact question, but you're absolutely right, Eric. The reason why the NEURONE tool was created in the first place is because when we were having those discussions with business owners, with IT consultants, we came to realize that with the tools that existed, we weren't able to properly answer a lot of those complicated questions. Okay, I am incorporated. I want to maybe sell my corporation next year. What's going to be the impact? How can I plan in advance? So as an example, right? So the NEURONE tool really was a way for us to be able to provide something that helps us answer those complicated questions. But we'll be addressing that later on for sure.
Thank you, Leo.
What I want to talk about now is the corporate investment policy, right? Which for us is really a non-traditional way, a non-traditional investment approach that really fits in our global wealth planning philosophy that we use systematically for all the business owners and all the IT consultants that we have the pleasure to work with, right? So I guess the way to explain it would be the following. So you yourself, you are an independent IT consultant, you have a corporation, you earn income through that corporation from the different contracts that you're working on right now. Hopefully that income covers your fixed costs, right? So your regular business expenses, which can vary. And then hopefully it covers your own personal cost of living, right? So you have your mortgage to pay, you have your groceries, you have your trip to Hawaii coming up. Okay, so whatever you have going on, hopefully your income covers that. Once you've covered your cost of living and your expenses, hopefully you end up with a surplus in your corporation. You have money at your disposal. And then the question becomes, right, what do I do with this money? Okay. For business owners, IT consultants, okay, people that incorporate it, what's important for you guys is typically we get 4 answers when we ask you guys what is important. Number 1 is protection. I want to be sure I'm okay. My family is okay. I want my loved ones to be taken care of. I want tax efficiency, right? So not that I don't want to pay any tax. I want to pay my fair share of taxes, not $1 more. I want to create
the amount legally possible.
Yeah.
There you go. There you go. That's the best way to put it. Okay. Number three would be creating wealth. Obviously, we want our wealth to increase over time. And then the final one is I want to make sure my wealth is being transferred the right way. So the corporate investment policy aims to achieve really those exact goals, right? So we set out how much you should be investing, when you should be investing, what asset classes we should be using, what should be the ratio between those different investments, what order should I make those deposits, where, when, and where should I withdraw my income, okay, and every other aspect of managing your investments and building a really diversified portfolio. So this is the corporate investment policy. We use three key pillars, okay, three key strategies, and I know Eric has talked about that in the past. Three strategies that IT360 and NEURONE, we implement those strategies systematically for all the people that we work with, okay? And we summarize it into three pillars. So the first pillar for us aims to provide protection while also creating tax savings for yourself, for your family, for your corporation. The second pillar aims to efficiently build your retirement nest egg. And this is especially important for IT consultants because most of you don't have a corporation that you can just sell once you get to 60, 65-year-old. So you need to build that retirement plan in advance. For us, this is the second pillar. And then the third pillar aims to provide a tax-efficient portfolio structure on your investment growth from your non-registered investments in a corporation, okay? So we'll obviously talk a lot about the NEURONE tool today, but I think it's important to just briefly touch on all those pillars and just do an overview of what they all mean, okay? So the first pillar I said was all about risk management, okay? So in other words, the goal is to offer that protection and obviously increase your net worth along the way. We do so by using two strategies, okay? What we call the executive health plan, the EHP, and the estate retirement plan, the ERP. Imagine this, okay? Imagine you could have a financial product that could have the following characteristics, okay? So number one, something that has no market risk, okay? Very trendy with the fluctuations that we're seeing right now in the market. So this financial product has no fluctuations. Financial product that will provide a tax-efficient way to draw money out of your corporation, okay? What we call defiscalizing assets. So how can I use what's trapped in my corporation and have that in my own personal hands without having to pay too much tax, okay? So that's the second characteristic. Third characteristic, a financial product that gives us higher returns than the traditional fixed income securities that we're used to, okay? So it could be a GIC account, it could be a bond portfolio, okay? Fixed income. And then finally, a product that could also, above all of what I mentioned, right, that could also provide coverage for myself, for my corporation, if ever I were to get critically ill, okay? What I've just described is the EHP, okay? It's the executive health plan. So yes, it is an insurance structured product. For us, insurance, when it's in a corporate setting, it can be very powerful. And the EHP is definitely proof of that. For us, it is not a cost, but rather a key portion of our global investment portfolio, which we call the corporate investment policy, okay? So quickly, I mean, how it works, we'll do it with a quick example. So every year, your corporation sets up a critical illness policy that is dually owned. So it's owned partially by the corporation and yourself. It's the corporation that makes deposits, that pays a premium in the EHP every single year. And then part of that premium, you have to pay tax on it personally. Okay, in our example, the premium is $14,000. You have to pay around $6,000 in personal tax. So you do that either by declaring a dividend, it could be a taxable advantage, okay, whatever. You do this over a period of time until we get to, there's three outcomes, but I would say there's two main outcomes that usually occur. The first outcome is the one we hope not to get, right? Which be a case where you would get critically ill, okay? So cancer, a stroke, okay, heart attack, okay? So if that happens while we are covered, the insurance company will write a check to our corporation. Okay, in our example, it's $500,000, the coverage amount. So the corporation writes the insurance company writes a $500,000 check to my corporation, completely tax-free. Okay, and we can use that money to cover expenses, repay suppliers, okay, cover our own personal needs. Okay, we can do whatever we want. So this is obviously, it becomes beneficial for the corporation, right? Imagine it happens year 5. So you paid $14,000 in premiums for 5 years, but you get a $500,000 check, okay, because you were critically ill. The second outcome is the one we're hoping for, obviously, which would be an outcome where we don't get critically ill, right? Would be an outcome where we stay healthy during the coverage period. In this scenario, okay, the insurance company, if we stay healthy, can reimburse all the deposits we did in the EHP. Okay, and typically that's going to happen after 15 years. So I get to year 15, I remain healthy during the entire time. The insurance company will send a check for all the premiums that were paid, but that check, it's going to be, number one, it's going to be tax-free, okay? But it's also going to be sent to you personally, okay? So in our example, I made $14,000 deposits every year for 15 years. That's $210,000 of deposits in the EHP. Remember, I only taxed myself on a portion of that income, or a portion of that premium. I only taxed myself on around 40%. But the insurance company will reimburse the full amount to me personally, completely tax-free, okay? So if you consider the tax savings on that premium reimbursement, if you view that as profits, your policy ends up looking exactly like a fixed income investment, but it gives you far better performance and also offers you critical illness coverage. So by using that same example, right, the equivalent rate of return I would have to get in a GIC for 15 years is 8.48% per year, okay? I don't know about you guys. I haven't seen a lot of GICs that offer that type of return. Plus, GICs don't even offer any coverage. So the EHP for us really is a no-brainer in the corporate investment policy and in that first pill, okay?
And I think what I love too is that it's coming in tax free. And speaking of broken paradigms that Eric mentions in his book, the classic is everyone is told, save money, put money into your RSPs. And what we see time and time again is people, when they do pass away, they've got all this money in their RSPs, and now the estate's paying tax at usually the highest personal tax rate on these RSPs because they've been following this broken paradigm and not using other vehicles that they have available to them.
Good point, Andrew.
Yeah, 100%. So, and that's a good, yet again, another good parallel for the estate retirement plan. But for the EHP, earlier I mentioned the term defiscalize, right? Which I don't even think is a real term. But for us,
but that's okay. We're French, we can use all those words that don't exist,
We're allowed to, Eric. So we can use it in Quebec. Yeah. So defiscalize, really what that means is finding a way to use money trapped in a corporation and have that money transferred to my hands personally in the most tax efficient way. And this is exactly what we've been able to achieve within EHP. We only taxed ourselves on a portion of the premium amount, yet we're receiving 100% dividend reimbursements to ourselves, tax-free personally. So for us, really a no-brainer. The second strategy we use is the estate retirement plan. So, really to keep it simple, an ERP is a participating whole life insurance policy that, once again, we set up through the corporation. The idea is that now your corporation, part of the budget will be allowed towards the ERP, and we're going to be making deposits in the estate retirement plan for a certain period of time. Okay, so typically 10 years, sometimes 20 years. It's really up to you guys. As the years go by and as we contribute to our ERP, we accumulate participations, right? So our policy increases in value. The insurance company, when it's a participating whole life insurance, will redistribute part of its returns, part of its earnings to the policyholders. So this causes our ERP to increase, right, in value. So the cash value in our policy increases over time, and also the coverage amount, right? So we might start off with $1 million policy, but at the end, after 30, 40 years, it might now be a $2 or $3 million coverage amount, okay? So this obviously addresses important needs, provides coverage to loved ones, right? So if ever we have an event where we get a premature death, it's a life insurance policy, so provides coverage. It's also good for covering estate needs as well. And Andrew touched on that. So upon death, right, if we have an ERP in place, we receive a death benefit in our corporation that is credited to the CDA account, okay, which is a accounting term mostly.
Capital dividend account. Yeah.
There you go. So the capital dividend account, which basically allows your corporation to pay a tax-free dividend to your estate, okay, in our example, right? So that tax-free dividend, it's money that your estate can use to cover your final tax bill or cover other expenses as well. So I talked about defiscalization, okay? We're doing the same thing here. We've been able to defiscalize corporate money, putting it into the insurance policy, that insurance policy paying an amount to the corporation in the CDA account, which ultimately can lead to a tax-free dividend to my estate. So we're avoiding part of the broken paradigm you mentioned, Andrew, right? Having those RSPs that are taxed in the estate. Well, that won't be the case with the ERP.
And what I like about this product also, Leo, is a lot of our clients, you need to make a decision today for 10, 15, 20 years down the road. So it's sometimes a difficult decision to make. So this product is very, very flexible. When it's in place, you don't have to decide at the beginning if you want this to be fully for retirement or fully for estate transfer or whatever. So it's a very flexible product and it evolves with you along the way. And at the end, we realize some clients, we put that in place because they like the retirement planning that life insurance can bring. We arrive at retirement and they say, Eric, I don't need the money. I told you, you have way more money than you can spend at retirement, but you have a problem. When you die, you have $1 million tax to pay. Magic, the insurance that was in place for retirement planning has also that components of paying the tax bill. So we don't have to decide when we're 40, 50 years old. We put it in place and it will evolve and you can use it for retirement or use it for wealth transfer to the next generation. Good one.
Yeah, absolutely. So providing income as well, right? Because if that's a good point. You can get to a certain age where we realize, hey, maybe I have enough coverage, right? I don't need more. Well, then we can use, I talked about the participations that we accumulate over time. Well, we can have that paid to us, right? So we can receive basically an annuity from the ERP, from the insurance that we have in place. So yet again, Eric said it very well. So very flexible, the opportunities with an ERP. Another quick example, this time is for a 50-year-old doing annual deposits through the corporation. So it's here in our example, $55,000 of annual deposits. We're doing this for a period of 10 years. So we're investing $550,000 in the policy. Here, our Mr. Client here was able to generate a very important estate gain, thanks to all of what we've previously explained, notably the CDA account that we're really optimizing. So when we compare those deposits in the ERP to making that equivalent deposit in a traditional investment fixed income account yielding 4%, well, the difference is it's unimaginable, right? So from 55 to age 85, the difference net after taxes is almost $1 million, right? 934,000. So yet again, just as the EHP, the ERP, its place in our corporate investment policy really is a no-brainer, and it's part of the NEURONE approach. Moving to the second pillar now. So we talked about how I introduced this. The second pillar was retirement. So imagine this, okay? Instead of making personal contributions to an RSP account, part of the broken paradigms that we mentioned, right? We can now use our own corporation to make those contributions, okay? So it's our corporation that's going to be funding our retirement. The corporation will get to deduct from its earnings, from its income, the contributions that are done in the pension plan, which we call the EPP, the executive pension plan. And then yourself, right, you'll be able to receive personal income once you get to your retirement. Okay, so it's just a slight change in our approach. Instead of making personal contributions in RSP, we're going to open a pension plan and have our corporation fund this pension plan, but this slight change in our approach, it leads to very, very important benefits down the line. So obviously tax savings, common theme for today. So tax savings, we get additional tax savings in a corporation using an EPP. So yes, the contributions are fully deductible. The fees are also fully deductible in a pension plan, which is not the case in an RSP. So your regular advisor fee, the administrative fee for the account, fully deductible in an EPP. The contributions that we do, no payroll tax. So if I'm making a $10,000 contribution, it's a net $10,000 deposit in my EPP. And most importantly, the growth is fully tax sheltered in my EPP. So same as an RSP, as long as I don't touch the money in the plan, I don't have to pay tax on it. So it's a really great way to protect myself noticeably from the tax on passive income rules that we mentioned at the start, right? I'm not generating any passive income in my EPP because it's tax sheltered. So it's a really, really, really interesting strategy. Also the contributions, okay? So we know that some of the inconveniences of an RSP is the contribution limit and the fact that we cannot go above 18% of our T4 income every year. Well, now in an EPP, that contribution limit is much higher. Okay, it can reach up to 30% at age 65. So we get to do more contributions, or we can do past service buybacks, we can do contribution top-ups. Okay, so different types of contribution opportunities that exist in a pension plan that simply do not exist in an RSP. Okay, and then finally, another thing I think is very important to mention is the risk mitigation part of the EPP. So an EPP, fully creditor proof, okay, greater creditor protection than RSPs, and also the investment platform that we use, that Eric uses with his clients that have EPPs. It's an institutional platform, okay? So it gives us access to typically lower fees and also gives us access to additional asset classes. So we're able to invest in infrastructure, in land, it could be real estate, commercial, stuff like that, private equity, private debt. So when we add all that up and we build our portfolio, we're able to offer something that is much more diversified, much more robust, okay? That really mimics the pension plan type portfolio that we hear about in the news. Well, we can recreate that in an EPP, okay? So
and one thing
go ahead, Andrew.
go off from the EPP is you do talk about the creditor proof, which many of you may not translate that to PSP protection, but I absolutely do. So if you are ever deemed, God forbid, to be a personal service business, and EPP is still a valid deduction for a personal service business, which means anything inside the EPP is sheltered and protected against PSP risk as well. Which is, I think, a very critical point. You know, we argue that you are not a personal service business. We would fight till we're dead on that point. But God forbid we were unsuccessful for whatever reason, anything in an EPP is still a valid deduction to the corporation, even if you are deemed a PSB or PSC. So, you know, that's effectively what the creditor proof means. And from my perspective, it's one of the most important aspects of it, because I know a lot of people are worried because with PSB, although we fight against it and we do everything we can to protect our clients, every judge in every court case on PSB has always said every case needs to be judged on its own individual merits.
Yes.
And, you know, if the courts start ruling in the opposite direction, you know, an EPP is a great way to shelter and provide an extra layer of protection. And, you know, if you've attended any of my PSB sessions, you know, the goal and the objective is to wrap you in as many layers of bubble wrap as we can and consider the EPP one more layer of bubble wrap.
Yep. Great point, Andrew. Thanks for thanks for adding that in there. So just to I guess summarize, right? The first pillar was the EHP, ERP, right? Protection, tax efficiency. The second pillar, the EPP, which gives us yet again tax savings, greater wealth accumulation on a tax sheltered basis, and also that creditor protection that Andrew elaborated on. The final pillar of our corporate investment policy aims to provide really a more tax efficient portfolio structure. Okay, because in our corporation, yes, we'll be investing in EHP, ERP, EPP. If there's still assets left over, those will typically be going to a non-registered corporate portfolio, okay? And we need to make sure that portfolio is well constructed. The reason why, right, we saw it earlier with the different taxation levels on the certain types of investment income. When we look at those different sources, we talked about, foreign income potentially being taxed upwards of 67%. Well, what we want to do is we want to prioritize the investment income that is not as highly taxed. In this case here, we're talking about capital gains, okay, which are taxed only 50% of the gain is taxed, and Canadian dividends, all things considered, are not taxed as heavily as interest income and foreign income. Okay. When we invest in what we call a mutual fund trust, which is your typical portfolio that you'll find, most portfolios will be constructed as a mutual fund trust. You'll find Canadian equity in there. You'll find US equity. You'll find foreign stocks, foreign bonds. Okay. In this type of portfolio structure, we have issues. Okay. Typically, distributions are going to be more frequent. So we're going to be paying tax sooner rather than later. We're going to be more highly taxed because we have that interest income and we have that foreign income as well, right? And the expenses in our pool in the mutual fund, we can't use them as much as we could in a corporate class fund. Okay, so for us, it's very important to use the structure that we see on the right. So in a corporate class fund, taxable gains, losses, incomes, expenses from all the funds in the corporation, they can all be combined and they can all be allocated in a way that's really going to minimize the net taxable distribution to the investor, okay, to you. So distributions are going to be generally smaller, they're going to be less frequent, and they're going to be more tax efficient because we are prioritizing distributions in the form of a capital gain and a Canadian dividend. Okay, and just a quick example here. So yet again, we're just comparing. It's the same investor, it's the same portfolio, it's the same financial effort. Here, it's a $12,000 deposit every year. Okay, yielding 5%. Just from having a corporate class fund compared to the mutual fund trust over 20 years, we're gaining $20,000 in this example. Part of the reason is we're creating more CDA, the capital dividend account, which is always something that we look to do, right? I'm going to speed things up. I see that the time is flying by. So our baseline has been set, right? So NEURONE helps you implement a corporate investment policy. It provides a diverse portfolio, tax-efficient mechanisms. Still, for me, a key question left to answer, and this is the question that we get all the time. And the question being, how do I know I'm making the right decisions? Okay, I understand, Leo, all these vehicles, they're great. I see how they all add value individually, but how do I properly use each vehicle to its fullest potential, and especially according to my own personal capabilities, right? So in other words, how do I properly allocate this budget towards each component of the corporate investment policy? And this is really one of the key objectives and really where our famous NEURONE tool, where it comes into play. All right. Hopefully that the build-up wasn't too long. Hopefully you guys are still following along.
Yeah, that's good. That's good.
So you guys are IT consultants, right? So you work in tech. The NEURONE tool is all about leveraging tech, leveraging financial intelligence to facilitate that decision making, and optimize our global net wealth. Many years ago, a gentleman by the name of Danny Provost, very well known, very well respected tax specialist here in Quebec, he encountered a problem when working with the different tax optimization softwares that were available. Okay, he realized that a lot of these softwares, some of them that still exist today, right? They weren't necessarily up to his standard, and this is what Eric was referring to in the beginning. Okay, so a lot of rule of thumb, okay, in these softwares, a lot of cutting corners, a lot of basic optimization, not fully integrating the complete picture of your situation, not necessarily taking into account how our personal and our corporate assets coexist, how our personal and our corporate cash flows work. So that caused frustration, and it really caused Danny to really take this matter in his own hands, okay, and really start developing his own tool to really fully optimize a business owner and incorporate professionals' overall situation. The tool that Danny created, fast forward 20 years later, right, is now an industry-leading tax optimization software and is formally known now as the NEURONE Tool, okay? Danny's been working on the tool for over 20 years. Continuous research, development on the tool, also from peer-to-peer consultation. I know Eric has been talking to Danny for a while on just perfecting the tool, okay, continuously, making sure we're staying up to date with the different changes in the corporate tax landscape. So if tomorrow we get a new federal budget with a bunch of changes, well, those changes will be incorporated right away in our NEURONE tool. Just since January of 2022, right? So for the past 3 years or so, we've done over 200 updates and improvements to our tool, okay? So that's over an update and an improvement per week. So we really have Danny working full-time on making sure the tool is really top of the game, okay? So it makes the tool unique, okay? But above having Danny really working full-time, making it perfect, making sure it's always up to date, the NEURONE tool is actually powered by a very powerful mathematical optimization module that is really capable of using a significant, very significant amount of data and producing tax simulations until it eventually cracks the code, okay? And this is where we're really able to add a lot of value. And when I say crack the code, okay, what I mean is that the tool will start with a basic plan, okay? The basic plan that we would find in your common tax software, a plan where we could find potentially a lot of these broken paradigms, right? So start by putting money in your RSP, then put money in your TFSA, then use a non-registered account. Don't withdraw your CPP, QPP before age 65 or 71. Okay, so it really starts with this basic premise, and then it tries to find alternative combinations. Okay, so combinations that can really help add value over the long term. So it does projections of real life scenarios, and it evaluates every time the tax repercussions of each decision that we're taking, and it does so with a lot of precisiveness. Okay, so we put the tool to work. The aim, obviously, is to reduce tax, create wealth. So we're doing these income tax projections, those iterations, as the tool runs. So every time it really tries to discover a new path that adds value. So it digs, finds a path that makes sense. It will keep digging along that path until eventually, well, we've optimized the entire situation. So, and which differentiates the tool from your normal software, because usually your usual tax optimization software will just look to save you as much tax right now. So it looks at, okay, we're in 2025. How can I save as much tax in 2025? It won't always take into account the future repercussions of the decisions that I'm taking right now. And examples of that, we have a lot, right? One of the broken paradigms that Eric mentions in his book is to prioritize dividends as our main form of compensation and mostly disregard salary because, we know that a salary in the immediate term, we're paying a bit more personal tax. This is, it's true, and it's probably what a traditional software might suggest. But the reality is that a salary creates something called RRSP contribution room, or in our case, EPP contribution room. We're making contributions to CPP, QPP. So the NEURONE tool, what it does is it tells us and it shows us the long-term effect of paying that salary, making those EPP contributions, and then ultimately in the end, right, receiving that income from the pension plan instead of drawing out those dividends into retirement. So really what the tool is used for, right, is it tries to optimize the full circle. The decisions that we're making today, if they don't make sense 20 years from now, well, we won't be making those decisions, even if they make you save a lot of tax right now. Okay, so really the full circle, optimizing your net lifelong wealth is the goal of NEURONE. We achieve that using, it's an AI-powered optimization module, and it's a module that can produce up to 100,000 tax simulations in less than 48 hours. Okay, so imagine that, over 100,000 simulations in less than 48 hours. I think I had that on the previous slide.
I might get excited by that a little bit more than our clients who may not understand the implications of that.
Yeah.
But I can tell you, it's incredibly powerful. And everyone who knows me knows I love technology, and I love how you guys are using technology to make sure that you're setting the right path for the clients, because there are way too many people who either aren't working with a financial planner or who aren't working with a sophisticated financial planner, who make the wrong decisions. And ultimately, if we don't find out about that until it's too late, which ultimately we do, there's very little we can do. And what I love about the NEURONE tool is it gives you the capability of being proactive and looking down the line at the future, to the best of your ability. Nobody has a crystal ball, but this is probably the closest you can get to a crystal ball based on the information that you have available today. And I think that's incredibly, incredibly powerful.
Andrew, when I started writing the book, I mean, I use a ghostwriter to help me out. I never wrote a book, and the guy was saying, yeah, in every book, Eric, you need a villain. You need a
CRA, an easy villain.
yeah, and we went at the beginning to exactly, and then we realized, no, the villain is not CRA. CRA set up rules. The villain is bad advice. So I really like this one. Is CRA? It's you play Monopoly. You need to look at the rules and play with the rules.
Yep.
This is what it is. But bad advice is the real villain here. So this is what NEURONE is helping us to solve, definitely.
Yeah, for sure. So, and avoiding bad advice and really giving you a clear game plan, right? A game plan of what you should do and what you should not do with the money that you have sitting in your corporation. So really down the line, it helps us add a lot of value. I'll go quickly here because I do want to get to the final part, but a lot of tests can be done. So I talked about salary versus dividends. We could test if is it better to declare a capital gain this year, next year, further down the line, AMT clawback. So there's a lot of scenarios that we can evaluate. Real estate as well, right? I want to buy a 4-bedroom apartment building. Should I buy it in a corporation? Should I buy it personally? So it's all things that the tool can consider. So it goes very deep, and it does so in a very precise way as well. So every decision, every calculation considers public health benefits. So old age security, GST, childcare expenses, all that kind of stuff. It also takes into account the additional changes in the rules, right? We talked about the small business deduction with the passive income. So it will consider that as well. So really anything you can imagine. And this is how powerful the tool can be. We saw earlier, we talked about the corporate investment policy and how we integrate different concepts in our portfolio. Well, the tool allows us to see, to quantify the added value of using those different strategies. Okay, so we'll do a quick case study, 5 minutes max, just so you guys see what it looks like, and why, especially also how the corporate investment policy it helps us add value over the long term. So a quick case study here. We have a 50-year-old client. He's been an IT consultant, an incorporated IT consultant since 2018. Cost of living, okay, 100,000. He has some RSPs. He has some TFSAs. He's drawing out a salary of 135,000 a year. He's also drawing out some dividends. And the corporation, so this is someone that's doing quite well, okay, very well, I would say. So $400,000 of net annual profits. And we have some issues, right? So this is someone who's sitting on a lot of cash. He's got some real estate. Okay, so obviously when we look at this current picture, there's a lot of optimization that needs to be done. Okay, so starting with the left, this is our current portrait. So we have a lot of cash. So we got real estate. Okay, we see that other than that, there's not much more going on. And then we move to the right side, okay, where what we're doing is we're gradually implementing each strategy of the corporate investment policy. So we talked about the EHP, the ERP, the pension plan, the corporate class, okay? So the pie chart that we see, it really indicates how we choose to allocate our annual budget towards these different strategies, okay? And notice how those strategies, they represent around 30% of our global picture. And this is really to mimic or to recreate our 70-30 portfolio that we get with the growth portfolio, with a growth investor, right? We talked about finding better alternatives to passive income. Well, here we've integrated those better alternatives in our global situation. So once we've gathered all the data, we've implemented the strategies that we want to use, we click play, and we really let the tool do its magic. Okay, so obviously it's a little complicated for us to show you how the tool exactly works, but really imagine a sheet where you would have all your annual tax returns for the next 50 years all at once and all fluctuate, okay, until the tool finds an optimized combination of all the financial decisions that we'll be taking along the line. Okay, so and we can let that tool run for 48, 72 hours. It's 100,000 simulations that can be done until it finds really that unique formula that no other software really can produce for us. Okay, so it's a pretty robust tool. We need a pretty strong computer, but obviously the NEURONE infrastructure supports that. And then in the end, right, we get a 300-page detailed report. Obviously, that's not what we're going to be putting on your desk. We don't expect you guys to read 300 pages, but it's 300 pages of results. So it shows us what we should do. But what's also really, really cool with NEURONE is it also shows us how we got to those answers. Yet again, something that is very distinctive with the common tools that we see, the common softwares. So it tells us what to do, and it tells us how it got to those results. So this is something that's very powerful. And then once we've added all the concepts, we've added that tax optimization, we're able to add value. So scenario one, right, we start with a situation with our basic portrait that has no optimization. And then gradually we implement the different concepts of the corporate investment policy until in the end, we get to a scenario, right, where we've implemented all the strategies. And for this in this example right here, right, we were able to add $3.7 million of net estate value. That's not because we increased his income, right? He didn't work for a longer amount of years. No, we just refocused the strategies that we use, and we combined that with the tool's intelligence, right? And we were able to find $3.7 million more for this client. So that's more for you. It's more for your family. It's more for your legacy. So obviously, it's something very powerful. And then there's other examples of reports that NEURONE can do. Here's a quick example regarding the passive income rules. So in this example, due to better passive income management, it's over $400,000 of tax savings for the next 20 years. So just as an example as to how we get those results, right? So I guess and hopefully this was of interest for you guys. I'm pretty sure it was.
Yep, it's interesting to me, but I'm probably biased.
So I guess like just before I send it back to you, Andrew and Eric, I'd say NEURONE really it's a team. Okay, we have over 20 people working in the team full time, perfecting those concepts, those strategies, working on the tool, and really helping you guys design the most optimal portfolio for the money you have in your corporation and how you're going to be deploying that portfolio down the line. So that's it for me.
Good job, Leo.
I think we're okay on time.
Yeah,
And
yeah, very good job.
Appreciate it, guys.
We do have a couple of questions starting to come in. First, just some great session comments. But there was a question about what companies offer this EPP coverage, and which companies do you recommend to use for EPP? I have some assumptions, but Eric, I'll leave that one to you.
Yeah, basically, we've negotiated with several suppliers, but we decided that Desjardins was the best one to go with. They accepted to create a product where we have access to their institutional platform, and everybody is seen as a big happy family. So if Andrew has $1 million and Eric has $100,000, in reality, most people will charge more to Eric and less to Andrew because he has more money to manage. So what we were able to negotiate is with the billions of dollars that we have in the group, everybody pays pretty much the same fee. So why we went with Desjardins is because they followed us with all the requests that I had for the IT consultant across the country. So there's
and
one
I think
supplier.
from what I saw, it's based on the number of people that are in the EPP, correct?
Yeah, exactly.
Yeah, it's really straightforward. And the thing is, it's thanks to relatively recent legislation, it's affordable. There was a long period of time where EPPs really weren't a viable solution, even though they were still great tools back then, but they were prohibitively expensive because of there is a bunch of work and stuff that has to be done to go along with it, and they were quite expensive to manage. And now they've come down substantially, very reasonably priced, and are now effective tools for small businesses like IT contractors. And so I think you guys have a great product. And as you know, I'm a big fan. They're the protection from PSB. They're great from the tax strategy as well, the overall tax picture. You're getting a deduction right now and a deferral, much like an RSP. So anyone who's considering RSPs, EPP,
that's it.
Yeah,
no more
so
RSP. You have a corporation, no more RSP.
Yeah,
just talk to us or to Andrew, about EPP possibility, and it's a no-brainer. There's not a lot of things in life that are no-brainer. This one, no-brainer.
Yeah, absolutely. I would completely agree. And again, thank you, Leo, for doing such an amazing job of explaining a very complicated process in layman's terms so that we can all
My
understand.
God, is he good or what?
Yeah, he's excellent.
Oh my God. I will go cry in my closet now. After the kid did a great presentation. He's amazing.
Yeah, and so great that we only had one question out of it. So
that's good.
That leaves us on almost perfect timing as well, which is another difficult thing to do. And we got more people coming in. Leo was great. Another comment in there. So again, thank you, Leo. Thank you, Eric, for taking time out of your schedule. If anyone has any questions or clients of ours and you don't know how to get in touch with IT360, reach out to your account manager. They can make the connection. And as well, Eric, do you want to share your contact information for anyone who might be watching on any of the social media channels?
I'm not a very good techie guy, so I will have the email info will be just verbal. It's e.chevrette at finances.ti360.com. So next time I will have it ready on the screen with Leo, where they can, but they can.
And if
Google
anyone has
us,
any questions, they can tag us. We'll be happy to share a link and a comment. We have one more question before we go. Is the NEURONE software tool for sale? Probably, no. But you probably can't afford it. Everything's for sale for the right price. But
no, it's used internally. IT360 is one group working with it, and there's maybe 50 other groups of people in the financial center using and feeding the beast. Right. But it's not a tool
for 400 billion, they might be willing to sell.
Yeah, there's always a cost. Yeah.
Awesome. Okay. Well, thank you, gentlemen. Very much. And we look forward to seeing everyone at our next session in a few weeks. Have a good one.
Take care. Bye, guys.
Thanks, guys. Have a good one.